Hello, my name is Dallas Thomas, and this is my presentation on the analysis of the cash flow for McDonald's Corp. For fiscal year 2022. On the financial statement, there are three main areas that define the cash flow. The areas are operating activities, investing activities, and financing activities. Under the operating activities for McDonald's, we have two impactful areas labeled depreciation and amortization and share based compensation. Under investing activities, we will be looking specifically at sales of property and sales of restaurant and other businesses. Finally, under financing activities, we will look at the line items for long term financing issuances and proceeds from stock option exercises. Contrary to the last slide, there are also some major areas where the company is using their cash for specific purposes. Under operating activities, we will be looking at the items of net loss on sale of restaurant and other businesses, as well as income taxes. With the investing activities, we will pay attention for capital expenditures and purchases of restaurant businesses. Under financing activities, we will investigate long term financing repayment and common stock dividends. Looking at the consolidated statement of cash flows, you can see the areas we mentioned in the prior sales. First, under operating activities, we can see that McDonald's gained cash in the amounts of roughly $1.8 billion from depreciation and amortization, as well as another $166 million from their share based compensation program. Remember, this does not mean that they have the cash on hand, but merely that they can leverage these items to better balance out the finances of the company. Moving on, we have charges under operating activities for new loss on sale of restaurant and other businesses, as well as income taxes for the amounts of $570 million and $546 million, respectively. Next, we will explore their investing activities. Under this section, we can see a cash flow of $445 million from sales of restaurants and other businesses, as well as roughly $40 million from sales of other property. There are also charges for almost $1.9 billion for capital expenditures and another roughly $800 million that was spent on purchases of restaurant businesses. The final section we are going to look at is the financing activities. Here we see cash inflows of roughly $3.4 billion from long-term financing issuances and another $248 million that came from proceeds from stock option exercises. We also see that there are charges of $2.2 billion from long-term financing repayments and another almost $4.2 billion from common stock dividends. We can see on the cash flow statement that the net income was of the amount of roughly $6.2 billion, while the cash provided by operations comes out to $7.4 billion. The question becomes, why is this the case? Well, the answer is that these statements were created with an indirect method of accounting, and this gives the accountants some room to play with some of these non cash items. For instance, share based compensation is not paid out in cash, thus, the cash value has some play that can be used to free up some money from an accounting standard. This can also work with items like depreciation and amortization. In doing so, McDonald's can now show that the cash that was provided by these non cash items is to the amount of around $7.4 billion when added to the net income, rather than the amount of net income, which is over $1 billion less. McDonald's is in a strong position in the world of finance. They have enough cash flow to be able to take big hits and be able to take some larger risk. We can see this when we look at their long term financing issuances versus their long term financing repayments. There are nearly $3.4 billion in issuances, while $2.2 billion in financing repayments. What this shows is that they are making more on the things they are financing for others than they are when they're paying others for their own financing. Stockholders see that as well, as they have been able to buy into the company and generate a stock dividend cost totaling nearly $4.2 billion. However, a near equivalent number of stocks was put into the treasury stock. This line item is showing that McDonald's is staying on top of ensuring their stock remains viable, and they're also willing to spend money when needed. McDonald's is a strong, historically stable company. As such, there is not much going wrong regarding the cash flow statement. The one glaring issue is that you see a drop off in cash provided by operations of almost $2 billion when compared to the prior year. That year before this, there was almost a $3 billion increase, At the same time, they are spending more than they historically have, but not by much. Diving into the notes on this, management mentions that they took a hit due to the Russian Ukraine war. They shut down almost instantaneously all restaurants in Russia with no plan on opening again. This was an unavoidable event and one that could not have been accounted for prior. Due to this, it would make sense for McDonald's to spend a little more conservatively until they could find ways to recoup that lost $2 billion. Thank you.